Today, the big bond question. Hello again, it's Martin North from Digital Finance Analytics, with latest posts covering finance and property news with a distinctively Australian flavour. In the past few days, global bond markets have entered a strong bear phase, thanks to central bank messaging about controlling inflation. Transitory has now been largely dropped, although perhaps except in Australia. And so, as bond prices fall, bond yields rise, with a renewed push towards new multi-year highs. So there is clear bearish momentum now on bonds, but it's all supported both by technicals and data outcomes, such as the upsurge surprise on the US jobs report last Friday. In the US, the market was already debating the prospect of a 50 basis point hike in March, and that speculation is only likely to grow, despite the fact that the forward cash profile already implies more than 5 rate hikes in 2022. Ongoing inflation fears will again be a central focus this week, with the US CPI release for January expected to confirm price pressures at around 40-year highs. And the oil price continues to reach new highs as well, and as I've explained, hedge funds are piling in with a view that oil could well go above $100 a barrel, and some are expecting even higher than that. The recent pricing of European bonds in recent weeks was especially eye-catching, with a 10-year German Bund up 30 basis points, UK gilts up by 29 basis points, and Italian 10-year bond yields higher by 45 basis points over the past fortnight. As a result, there is actually not a negative nominal yield in sight, although of course real yields are still in negative territory. Over the same period, the US 10-year yield was up 20 basis points, while the 2-year was higher, up 30 basis points over the past fortnight. So we should expect a move towards 2% for the US 10-year bond, and probably even above that. And as to what's going to happen beyond, there is on one hand a clear path to higher bond yields as prices continue to fall, and so many holders will look to sell into strength to de-risk. But of course, some will also take the alternative view that central banks won't do what they said they're going to do because the market pressure will be so severe, and it may reverse. But we also need to ask the impact on corporate bonds and other loans, because higher rates cost. In fact, Fitch Ratings published an interesting note highlighting that interest rate rises will directly affect loan repayments, reduce cash flows, and increase loan refinancing challenges for certain structured finance asset classes, including retail mortgage-backed securities, student loans, and credit cards. Transactions may see a softening of the strong performance metrics observed during the pandemic, they said, and rate hikes resulting in greater debt burdens will pose affordability pressures for weaker borrowers, which could potentially affect the ability to meet other debt payments. However, they say asset performance will continue to be supported by relatively low interest rate levels and continued job recoveries. Fitch expects the Federal Reserve to raise rates in a series of actions in 2022 and 2023, moving the Fed funds rate to 1.25% by the end of 2022, 2.25% by the end of 2023, from 0.25% currently. Fed Chair Jerome Powell has declined to indicate the pace of rate increases, which leaves the door open to more rapid or larger incremental increases than expected, they said. Mortgage rate increases as a result of monetary tightening, the reduction of mortgage-backed securities purchases as part of the Fed tapering, and affordability pressures will slow home price growth, although robust housing demand and restricted supply are expected to keep it in the 5 to 7% range, they said. And Fitch expects the 30-year fixed-rate mortgage in the US to remain between 3 and 3.5% in 2022, but increasing further in 2023. Lower mortgage refinancing activity would affect pool cash flows, slowing prepayments and lengthening duration. Higher interest rates will make commercial real estate loan refinancing more costly relative to recent years, but borrowers with limited capital are at risk of not being able to refinance at all if rising rates leads them to fail debt service coverage thresholds required for refinancing, and loan-to-value thresholds if cap rates move higher with rising interest rates. A positive, though, is that loans maturing in 2022 and 2023, the majority were originated 10 years ago, and they have interest rates 109 basis points higher on average than the current market, providing some cushion, as does amortization for those loans that incorporated it. About $43 billion of loans in the Fitch-related CMBS, multi-borrower, and Freddie Mac universe are scheduled to mature in 2022 and 2023. Student loan refinancing will be less attractive to borrowers and may cause prepayment rates to slow, and lower prepayments increase the weighted average life of the portfolio assets and could eventually result in higher defaults as borrowers remain exposed to policy decisions, inflation and slow economic growth. For floating rate private student loans, despite increasing borrowing costs, the high percentage of loans made with a co-borrower in school loan portfolios and the higher credit quality of borrowers in refinanced student loan portfolios, they say, will remain supportive of default assumptions. But slower prepayments preserve excess spreads and can reduce negative selection from better borrowers being refinanced away. Slower prepayments pose the greatest risk to legacy transactions, which are more prone to exhibit liquidity risk at bond legal final maturity dates. And borrowers' savings are depleting as the effects of federal aid fade, and they expect to see lower credit card monthly payments as rates rise if borrowers elect to make lower payments or the minimum payment without being delinquent. Retail trusts may be more affected, but it's too early to tell if this will be material. And overall, they say credit card performance is expected to remain well within Fitch's expectations. But the point of this seismic shift in the rates will have consequences. And you've got to ask how things will play out into equities. The short answer is prices will fall. But the longer answer is it will depend on the sector, with companies able to pass rising costs on and with positive cash flows and lower debt better placed. But to me, the investment landscape is highly uncertain, so perhaps a time to remain cautious rather than chasing the next meme. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.